Let's start off with looking back at what happened last year. The impact of COVID, when we look at economic activity on a global scale, was one of the sharpest declines we've seen since post-World War II. Real economic growth declined during the first quarter of 2020 by 9%, and we have to go back to the 1950s to see the second biggest decline in economic activity. That was on the back of a lot of infrastructure spending out of Second World War II, where the Eisenhower administration started raising interest rates to cool down the economy, and then basically around about middle of 1957, the US economy contracted by 3.6%. The global financial crisis, more recently, we saw a contraction of 3.4%. So that just places into context the extent of COVID-19, the lockdowns we've seen. I mean, a 9% drop in economic activity is an extremely big number. But what was also quite impressive is how quickly economic activity actually started to bounce back. The expectation is for this year for economic growth to actually be back at the levels they were in December of 2019. So very sharp movements in the markets. And what was interesting when we look at what transpired over the last year, so if we go back, markets basically peaked around February 17th of last year, and when lockdown started being rolling out from Europe and then spreading to the US, we saw the investment markets taking pain. And what we're showing you here is essentially the winners and the losers of last year. Technology companies weathered the storm much better, still down 30% at the lowest point around about middle March. But the big pain was felt in those industries that are exposed much more to the global economy. That was in the financial space and in the energy companies. So obviously oil prices collapsed. At one point last year, you were basically being paid to take delivery of oil. But the markets actually bounced back very quickly. So if you look at what we're showing you here, you can see the midpoint we're indicating there, where the markets basically bottomed. And then you can see how quickly technology companies actually recovered. So investors in 2020 were much more confident in the ability of technology companies to deliver earnings growth. So the winners of last year was definitely a lot of technology companies, whereas the energy and financial sectors basically also recorded strong gains, but haven't really fully recovered towards the end of the year. So where are we today? So the markets are anticipating a much improved growth outlook. Towards middle December, when the first vaccines were started being rolling out, we've already seen investors on the bond market, which is normally a good indicator for expectations of interest rates and inflation. We can see that in the US, for example, long-term interest rates are basically moving upwards. So indication of that is that investors are expecting to see interest rates being increased. We've witnessed probably over the last couple of weeks a strong move towards expectations in the market that the US might actually start raising rates much sooner than anticipated. And we can see that being reflected in the movements in the bond markets. We're also seeing a strong move in inflation rates. The Fed last year basically came out with a very strong statement stipulating that they are willing to tolerate inflation on excess of 2% in an attempt to get employment back to almost full levels for the US economy. The big difference this time around, I think, in why there is potentially a concern about inflation, as during the global financial credit crisis, a lot of stimulus was provided for markets, a lot of liquidity, but it didn't get into the hands of the consumer. A lot of that money ended up on the balance sheets of companies. They conducted share buybacks. But this time around, it's clear that the Fed and the US government is definitely focusing on getting the consumer back on his feet. So a lot of payments are directly flowing to consumers. And we know that the US is a consumer-based economy. So as the economy starts opening up, we would expect to see consumer spending to pick up. We saw the same play out in China. Obviously, the lockdowns in China occurred over the Chinese New Year, so there's a lot of pent-up spending that didn't play out. And when the economy started opening up, we actually saw a big increase in consumer spending. So markets currently, when we look at markets and we look at these numbers, is showing us that investors are anticipating improved outlook for growth. That is positive for equities. But when we look at the equity market, what we are already seeing is that investors are shifting out of the winners of last year into those companies where the prices didn't really recover during 2020. So year to date, energy companies are actually the best performing segment of the market. Financial companies are up 18% in dollar terms. Broad market is up 5%. In technology, basically flat at around 3%. So this environment currently that we are seeing is an environment of improved growth outlook, anticipation of higher inflation and higher interest rates, and we can see that the asset classes are behaving towards that, as we see investors moving out of the high value, expensive companies with very strong growth prospects into those companies where prices lagged during last year. So if we then look at our portfolios, how did the portfolios perform? And I just want to break it down into the first part of 2020 when the markets corrected, or the sell-off in the markets. You can see the JSE All Share between the 1st of January 2020 to the 23rd of March declined by around about 33% in price. During this time, our portfolios participated, but we can see that basically we didn't participate to the same extent as the equity market. So our inflation plus 2 strategy, which is our more cautious strategy, declined only by 11.6, and then inflation plus 3 around about 14% down. Inflation plus 4 was 18, and then obviously what benefited our growth orientated strategies like our inflation plus 5 and global growth is the offshore exposure that they held. Then from the 23rd of March to the end of December, a strong bounce back on the JSE equity market, and our funds also bounced back nice and strong. So when we look at the year as a whole, our portfolios are actually recuperated all the declines experienced during the first quarter of 2020. So the 2020 was an extreme volatile year for investors. It was a rough roller coaster ride, but I'm fairly happy to say to our investors that our portfolios weathered the storm. And the big benefit of this is our portfolios are well diversified across various markets and various asset classes. So we place a very big emphasis on managing this downside risk of our portfolios, because we don't want to participate in these big swings in the markets. We want to make sure that we can preserve the capital of our investors. So if I can just then look back at the latest numbers available to us. So this is as of the end of February, looking back over the last 12 months, how did our portfolios perform? Obviously for our investors, what's important is the ability to beat inflation to ensure that our purchasing power of our portfolios keep growing. So inflation plus 2 was up almost 12%. So well ahead of its target, which was around about inflation plus plus 2 would have been 5%. So inflation plus 3, also strong returns for us, also well above its target. Inflation plus 4 was up 18% over the 12-month period. And then we can see our inflation plus 5, 19%. Global growth up around about 15. Why slightly lower than the rest? We've actually seen a very weak dollar. During this time period, a lot of investors are moving out of the dollar into other parts of the global economy where there's potentially better growth outlooks. And this strength, the weakness of the dollar actually impacted then our offshore exposure in our global growth portfolio. But we are fairly confident that our portfolios are still delivering on our inflation beating objectives. Then to conclude, how are we currently positioned? And obviously there's a lot of moving parts in our portfolio that we look at. As I mentioned, we try to make sure that we are well diversified. But if I can highlight 2 key points, and I'm focusing here on the growth assets and the income yielding assets. So if we just look at the outlook for real economic growth globally, what we are seeing, and it's been a view of the investment committee now for quite a while, is we believe that there's better growth opportunities outside of South Africa. South Africa got some constraints in terms of the maximum potential growth that we can generate due to infrastructure limitations. So electricity supply is a big concern. Our economy will struggle to grow in excess probably of 3.5% to 4%. Due to that, we've got infrastructure constraint in terms of getting our commodity out of on the rails and out of our harbors. So there is almost a cap at the level of growth that we can expect from South Africa until we fix our infrastructure challenges. So from the growth perspective, we favor offshore growth assets. What we do like in South Africa is the fact that we are still earning a very high interest rate and interest in our market. So the portfolios are biased offshore for growth, and within our income, we prefer holding South African yielding assets. Within the offshore exposure, emerging Asia, especially China, we think the demographics is in favor for markets there. They've got a young growing population that's well educated and hardworking, and we expect to see better growth coming through in those markets. We've also recently started to increase our exposure to financials. It's a segment of the global equity markets that lagged during 2020. And we think there's an opportunity for us to generate additional upside for our portfolios. We invested in Berkshire Hathaway probably towards the middle of third quarter last year, and it's already generated some very handsome returns for our investors. Then we are building up exposure into listed global infrastructure. We think that the Biden administration will push very hard to get infrastructure spending through in America. There's definitely a much bigger drive, not just in the US, but also in Europe, on clean energy, getting carbon emissions down to zero. So a lot of spending will probably be playing out in infrastructure, and we are slowly looking at investment opportunities available to us. Then, as I mentioned, there is concerns about inflation pressure building, and to provide some protection against that, we've also bought some US inflation-linked bonds. So effectively, as inflation increases, these investments actually maintain their value with inflation. So that's in essence how the portfolios currently are positioned. I think to summarize, the market is looking forward for improved growth. So I think as vaccine programs start picking up, you're going to see markets trending higher. It probably is going to be a bit of a stop-start. There's going to potentially might be some setbacks, but the overall mood of the market currently is definitely that we are seeing an improved outlook for growth, but we need to watch out for where inflation might be picking up. But as I mentioned, we are already looking for assets and ways to protect our portfolios against any potential spikes in inflation. Thanks, Andrew.